Hey, Dan Passarelli here. Happy Monday. I was looking at the SPY chart today. In fact, I was looking at a lot of charts today, and I was thinking about volatility. So one of the ways that civilians, that is non-option traders, look at volatility is they look at the ATR, the average true range. And that gives us a good picture of volatility from a certain perspective. It doesn't tell the whole story, but it is useful. Let's take a look at three different types of volatility really quick and talk about what story they tell and how we can use it. Let's start at the bottom here. So average true range, ATR, is what? Well, what that does is it takes the range for a single candle today, and it compares it to yesterday's close, and it uses yesterday's close to today's high or to today's low, and it takes the range of today and it looks at what the true range is, because if there's a gap in the stock price, we have to kind of count that. We can't just look at the high and the low of today if yesterday it closed way up here or way down here. So in a lot of ways, it gives us a better idea of the true range. Now, why do we call it the average? Because what we do is we take a moving average of that. Typically, the default is a 14-period moving average. And as we can see, since the big crazy move here on April 9th, or well, actually starting on April 10th, we've got a decline in this volatility. Now, this is the intraday volatility, and that's a very important part of the story because it calculates something very, very different than historical volatility. Historical volatility is intraday. We take the closing prices from the past month. So that's not what the range is on this candle averaged out. That is the standard deviation of all the closing prices over a whole 1 month period. So it tells a very different story. And then, of course, implied volatility is basically how cheap or expensive options are. So if we look at the average true range, and you can see where I have this line here, right? We're getting back down to, well, basically where we were in the month of March. Now, that's still higher than it was before the month of March during this 6-month period. But if we look at historical volatility, well, it's kind of the exact same story, really. Right? In fact, we're a little bit below where we were in a lot of March, most of March, and still above where we were before that. Now, implied volatility, that is hanging a little tight. That is more where it was back in March, and just very, very, very slightly above where it was before that. The important takeaway here is that if we compare the historical volatility, because that's kind of what we care about more when it comes to option trading, unless we're trading zero DTE trades, which many of us do, of course. But for non-zero DTE trades, we care about what this historical volatility number is, and it's 16.8. We'll just round it to that. Now, the options that we can sell here are trading the 1-day, 2-day, 3-day. They're trading below 16.8. This 4-day one is trading above there. It's kind of the most expensive options on the board, and then we're trading below there from there. So if I were to look for an option to sell, I would surely be looking for the June 6th expiration. Now, of course, tomorrow that's going to start to change, but maybe getting in on the open for all our aggressive option sales seekers, that might be a pretty nice way to get a little bit more of an edge than you could by selling any other expiration. I hope that helps. This is Dan Passarelli. Trade smart.